And joining us now as we take a look at what happened in Wednesday's market trade, Mike Zuzolo, Global Commodity Analytics. He is our guest today on Market Talk. Mike, great to catch up with you, sir. Hope you're doing well.
Doing great, Jesse. Happy Wednesday to you.
Yeah, fantastic to have you back on. I know I am here at Farm Progress and enjoying the weather. You're in your office there in Kansas. And as we take a look at the markets, though, on this Wednesday, we're looking at the same screen. Kind of peculiar trade, it felt like overall. Kind of that end of the month fund money flow kind of trade. Wheat ended up okay. Quarter beans down a bit in the grains, but really just overall broad picture. What was your thought with Wednesday's close?
Yeah, I think you nailed it with the fund money and the end of the month. I would throw on top of that the delivery process starting on Tuesday night. I would throw on top of that the issue with the pre-holiday trade probably starting to creep into this market. And I think I would also throw on top of it some new fundamental activity that maybe helped propel the wheat higher and the corn lower. And that was probably the biggest question I took from clients and subscribers that I talked to today that called in was, why is the corn all of a sudden the one being short on the short side of spreads? And I think it really is because USDA put out some key data. And what I mean by key data, Jesse, is that they put out an agricultural trade outlook in May and also in August. And this is the table in volume terms of what USDA is looking at. And we'll kind of hone in on the blue box there. We're looking at corn and sorghum forecasts volume of exports by the United States dropping pretty substantially. You're looking at May, for instance, in corn was 63.5 million tons as their estimate for the marketing year. That dropped yesterday to 62 million tons for the 22 marketing year. And they're also now giving 23 marketing year forecasts in this report. So to me, it's one of the most important reports that they put out because it's one of the most clear-cut reports they put out in terms of forecasting. And they only do it, like I said, about once every 6 months. So you see a pretty big drop in corn, see a substantial drop in sorghum. But look at the wheat, the very top line, you went from 20.3, stayed at 20.3 for this crop year. You're not losing any demand. And then they jacked up the 23 crop year to by 2.3 million tons. I think that really helps explain why the corn took the short side of the spreads, along with some new news coming out of Ukraine in terms of a fresh missile strike in a key grain storage facility along the Black Sea or near the Black Sea. And also the UK or the Ukrainian agriculture minister saying that their year-over-year exports of grains for the month of August were down 60%. They only got out about 1.3 million tons of corn and about 763,000 tons of wheat the whole month of August. So I think the market's recalibrating in favor of the wheat again as we closed out this month.
And that was what I was going to ask as well. We've talked about this a little bit, wondering if wheat was going to maybe resume the leadership role. And to your point, and looking at some of that data and looking at some of the market moves we've had this week, kind of feels like wheat is trying to resume leadership in the grains.
I think so, from both a technical and fundamental standpoint, minus or in extra on top of what we've already talked about when it comes to the Chinese drought. I think has done some damage to the rice crop in central China. That's going to create an environment where rice is probably going to participate more in grain rallies and maybe even lead some grain rallies here in the not too distant future. So that's another fundamental feature that I think is relatively new to this trade. I think also closing out the month of August, we hit that major trend line again in both the soft red wheat and the hard red wheat. Those trend lines held, and we're quite a ways above those trend lines as we walk into September. In fact, it'll be interesting. You'll probably find this interesting, you and the listeners. We ended up, even with the corn breakdown on Wednesday's trade, still being up almost 9% in lead month futures for the corn. Soybeans, however, dropped about 7.7%. So you can kind of see the damage done by the USDA yield increase, the pro farmer tour, and then those crop conditions. They all worked in conjunction with each other these last 2 weeks of August to really kind of pound out some premium and suck out some premium in the soybeans.
Well, let's talk a little bit as well about corn here, a little bit more. December corn. I'm going to pull up this chart that you have for us as well, and just look at some of these value levels, Mike, and walk us through a little bit more in this corn market. Just some of your thoughts with the price action we're seeing currently.
Yeah, I mean, this value level analysis I've been doing for many, many years, and it's based upon world supply demand fundamentals, US supply demand fundamentals, the dollar, crude oil prices. There's about 12 or 15 things that go into what makes a corn price overvalue or undervalue. And I do this for all the major commodities. And what I've done, I keep track of my changes made. And this is one of the most extensive or aggressive change years that I've had. I usually don't change these numbers very often at all, Jesse, but I do keep track of what I do. And so I've essentially raised the corn overvalue level by about 70 cents since the start of the year. I did it once in March, and I did it again just here today. That's because I firmed up my yield estimate of 171.5 nationally that you and I talked about last week. And with the supply demand fundamentals that I'm looking at a total use of about 14.5 billion bushels in domestic corn usage. I see less competitors out there in terms of actual supplies. USDA on that Ag Outlook update that I was just talking about, the reason they cut the corn demand down for the United States was because of China coming in and taking on more South American grain. And I think that goes directly to the point of China working to lower some of the genetic standards and some of the other standards to get Brazilian corn and sorghum in before the end of this year, before the end of this marketing year. But even with that, I think we're still very tight with about, in my estimation, about a 7.5% stocks to use ratio here in this country, and down on the lower end of the last 5 years in the world ending stocks. And so my overvalue for futures is 685 at this point. So I'll be starting to ramp up on a lot more hedge recommendations if we can break through that here in the next couple weeks.
You know, Mike, I've been hearing a lot of conversations on the ground here at Farm Progress Show about fertilizer and what that's looking like heading into the fall and into 23, and even some conversations of some growers wondering if they can lock in fertilizer for next year. Maybe they lock in some D's 23 corn, they lock in some November 23 soybeans. What are you maybe hearing on that front? What are your thoughts there as we look out a little bit longer term with this fertilizer picture and some of these crop inputs and seed costs, et cetera? I mean, if you could manage your margin, is it smart to lock in a little bit right now?
I'm not on the side of locking in any 23 corn, Jesse, at this point. And the reason that is because I put out a text blast to all my clients and subscribers a week ago Friday and recommended getting their spring needs locked in. I'd done my fuel needs for the fall early on, probably 2 or 3 months ago. I did some more nitrogen needs for the fall just pretty much a month ago, roughly. And then I was, being asked about the 23 by the clients. I was waiting for the end of August to see how the European market shaped up. And it's not getting any better over there. And so I went ahead and made that recommendation last Friday. And I had several clients call in and say, we were about a week too late. Everybody's pulled their bid for 23 because they don't know what the price is going to be. And I sat there and I thought to myself, this is rich when you have these massive companies that have the ability to hedge. They have the bankroll. They have the banks behind them. Why weren't they pre-buying stuff for the 23 crop year when they knew that the acreage base was going to be there, because they knew the corn yield was going down because of all these tours and all the USDA data that was going out there? And it's just, we continue to fight in agriculture this just-in-time mindset. So I'll jump off my soapbox and I'll say, I can't foresee locking in and taking the risk on new crop corn if I can't get my major input locked down. And we just know in 23, if there's any cash rent contracts coming up with the price of corn and with the demand base that we're probably going to see higher cash rents in 23 compared to 22 and 21. So I can't see any need or risk management mindset to lock in corn. I think it's the exact opposite. You're probably taking too much risk locking in corn at this point for 23, especially if we don't get rain the first 2 weeks of September of this year to lock in and solidify our yield numbers here now. So beans, I talked to somebody on a one-on-one basis, but corn, I just can't see it yet.
Well, I'm jumping around a little bit on my conversation, just kind of going off of what you're saying, as well as some thoughts I've had here from Farm Progress Show. And I want to go back to soybeans. You mentioned China. We did see some sales here to China on Wednesday morning. There's some rumors in the trade that there's been some cargoes bought from Chinese of both U.S. beans and South American beans. So you look at soybeans, we look at the yield estimates that are out there from the various tours, catching some rains. One has to wonder, is this soybean market, are we getting bearish here? Are we looking to kind of stay neutral? I mean, you look at all of this thought, broad scope. What's your thoughts with soybeans right now moving into September, Mike?
Yeah, I mean, and this is very this market in soybeans has priced in a lot of negativity. It's taken a lot of premium out. I felt like the air in the balloon was too full for the soybeans, given when we were up at 16 plus dollars, and that we were already pricing in about 110 million 100 million metric ton carryover for this coming year, this fall's crop. And so I do feel like we're a little bit more equalized and more at equilibrium, Jesse. I think where the next 15 days are is that if we don't get key rains, I think you could be right back down to 100 million bushel carryover mindset in the trade and the need to ration demand. And so I still think that the rains come, beans are the leader to the downside. But if the rains don't come, I mean, even the clients in Indiana and parts of Illinois and in Iowa are telling me that, you know, they've got some really good pods like the Pro Farmer Tour showed. Those pods aren't going to fill out with both the heat and dry weather. So I feel like we're going into the long weekend kind of feeling more like a weather market to me, even though it's September, because so much is riding on this relatively young crop, this relatively late crop, especially north of I-80, to provide us with that 52 bushel national yield. We're not there yet, I don't think, but the trade was probably well below 52 bushels 2-3 weeks ago. And it's interesting because, you know, we had an August high of $17.37 in lead month futures, and we're going to close just above 15 bucks. So you knocked over $2 off the lead month futures price in September and crushed that September November bean spread. So that's kind of what I'm getting at when I say we've really pulled some air out of the balloon at this point and brought up the ending stocks mindset.
Great thoughts. And you brought up as well, you know, the fact that we're going into a long holiday weekend. And I think it's a good reminder of, you know, folks to not necessarily get caught up in the day to day, the hour by hour, but have that plan, stick to it, because we know with holiday weekends, we could see volatile trade either into or out of or both, Mike.
Yeah, exactly. That's a really great point, and it's a really classic point to make during times of emotion when you want to let your throw your discipline out the window. There's what's called a cancel if close order, and that's when you have an open order in to sell some beans or corn or wheat or whatever, and you get close to that price that you wanted to get 2, 3, 4 months ago, and all of a sudden you're close, you're pulling your order saying, I don't want to sell it now. And you got to ask yourself, why don't you want to sell it? Do you really not have the yield? My advice, generally speaking, Jesse, is when you have that circumstance, maybe cut back on the amount of bushels you sell, but still pull the trigger to keep that discipline in the market. So that's a really excellent point if we are indeed heading into that second weather market of the crop year.
Mike, let's talk livestock. Kind of peculiar trade there on Wednesday. We just kind of lost some momentum. I know feeder cattle came back a little bit at the close, but overall, just a downside pressure, it felt like, in livestock overall. Is this maybe tied to the broader, just some of the macro money flow moves to end the month, the inflation worry, or is there something else at play here in the livestock trade?
No, I think it is that and a combination of the cash market, Jesse. I mean, we think about the grains versus the livestock and where the funds are, and they're very long again in the livestock sector, especially they were in the cattle and they had been in the hogs as well. And so I do think when you see the crude oil market drop and the cotton market drop, you see gold and silver drop 5 weeks in a row. I mean, excuse me, 5 months in a row. It's very hard to find a chart in a period of time where you've seen gold and silver drop 5 months in a row. I think it's only once since 28. The last time was 2018 with gold, and I think 2013 was the last time we had 5 or more weeks down. You don't get past 6 months down in the gold or silver. So 6 months down, 5 months down, that's historic. And I do think that draws some attention to the longs in the market. But I also feel like the cash market's really kind of found some equilibrium. We closed down about 24% in hogs between the August contract going off the board and the October never really picking up much steam. So cattle lost its hog support. We lost that belly seasonal, and we also go into kind of a negative seasonal or weaker cash seasonal for cattle because we're coming up on that last summer grilling holiday. And so I feel like the market feels pretty good about seeing a 3 pound increase in dressed weights last week, seeing almost a 4 percentage point increase in production and beef production versus the same week a year ago. They're getting the cattle at the price that they're buying them at. So that 133, 135 area seems like it's getting a lot of attention, and I think they feel pretty comfortable at this point as we close out summer.
Very, very true. And I wonder as well as we hit this last bit of summer and this last grilling season, kind of weekend, we start to head into the fall. I think we're going to be watching some of that demand maybe slow, but also we're still watching inflation in these markets and the recession fears. Fed Chair Powell last week on Friday made his comments in Jackson Hole. And it just feels like that's still kind of this weight that's over all of our commodities, not just the livestock sector, but grains, energies, you name it, etc. A lot of issues there, I think, that we still have to keep in mind as well, Mike.
Hey, that's a great point to round everything out on. China put on additional COVID lockdowns in major cities like Dalian and Shenzhen this week, and they may go even further out for a longer period of time. This matters now to the trade. In fact, USDA's Ag Outlook, they took the growth of China down from like 5.4 or 5.5% all the way down to like 3.3% between August and May. So the market's getting it, what you and I have been talking about, that China equals commodities. And if they're not doing well, the commodity market demand mindset, that sentiment's not going to be there to jump on and say, oh, wow, supplies are falling and the demand's not going down. You can't say that right now. You got to wonder if the demand's not going down as well with the supplies. And I think that's what makes it such a rocky road and a volatile path we've got to look at here.
Well, Mike, before we run out of time, any other final thoughts you have for us here on the show today?
I would say get ready to get some hedging done, but I'm still sticking with the paper side of the equation, Jesse, on the grains, especially because the basis is not really moving like I want it to. There are portions of like Northern Illinois where they're getting into almost like just a 5 or 10 under fall basis. That's a pretty decent basis. So I would say, generally speaking, though, stick with the futures type paper positions, the bought puts mindset when you get ready to do some hedging. But September is usually a pretty decent month to get some hedging in place.
Well, Mike, if folks want a little advice and want to work with you and look at your analysis, I know globalcomresearch.com is a great place to start, isn't it?
Yeah, that's the best place to go because I send out a lot of information. It's almost all electronic. So go to globalcomresearch.com, globalcom with 2 M's, and sign up for a trial. It's free. I'll call you at the end of 2 weeks and see if there's not something we can find for you, because we do subscriptions, we do cash-only marketing, and we do brokerage as well.
Well, Mike, always a pleasure, sir. Thanks for joining me here on another Wednesday while I am in wonderful Central Iowa, and I'll look forward to talking to you next week.
Safe travels, Jesse, and thanks for having me.
Thank you so much. Mike Zuzolo, Global Commodity Analytics. That's going to do it for today's Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.